So how much does an FHA loan really cost you? The ugly truth about down payment assistance programs and the hidden truth about conventional mortgages. I'm Joe Chavarria, and this is another episode of Cup of Joe. So today I want to talk about some secrets around bad credit home loans or home loans that require lower and less than perfect credit scores, and kind of what are the hidden fees, what are the terms, and well, maybe not specifically the terms, but what are some things you can expect so you can kind of uncover some of the truth and facts behind around these types of loans. And so I want to just remind everybody to like, share, and subscribe to either my podcast or my YouTube channel. And if you are watching this and you are in the process of becoming a homeowner, maybe you're looking to get approved for a mortgage loan in about 3 to 6 months or sooner, comment yes below or comment no below if you are looking to become a homeowner or if you're not looking to become a homeowner. Hit my microphone there. Sorry about that. So anyways, let's dive in here. So the truth around FHA mortgages. How much is an FHA loan really going to cost you? So when it comes to mortgages, you have a couple of different loan types. You have a VA loan for veterans, people that have served our country. They can qualify with, they can get VA benefits, which are typically going to allow their down payment to be covered. So it's like 100% financing, a lower score requirement. So there's a higher debt to income ratio requirement. So for veterans, there's a lot of programs out there for veterans. If you are a veteran and you haven't used your VA benefits to secure a home loan, you definitely want to look into that direction. But let's just say you have the other two types, which are FHA and conventional. So with conventional, you're going to have a higher score requirement, sometimes a little bit of a higher down payment requirement, but your interest rate and your monthly payment is typically going to be a little bit less, typically, right? And then you have your FHA loan, which is your most common type of home loan, especially for like first time home buyers, second time, third time home buyers, people kind of been doing it for a while, kind of have that experience with FHA loans in the past. And so they're, looking to kind of save some money and get a better loan by going to a conventional type of loan. So with FHA, typically the credit score requirement is, I've talked to lenders, and some lenders can do credit scores down to 500, most cases around 620, 640. FICO mortgage, by the way, guys. So this is not your Vantage credit scores, which you get from Credit Karma. These are not your FICO credit card scores you may have from Capital One or Discover. Those are your FICO bank card scores. I'm talking about your FICO mortgage credit score. So the mortgage companies use FICO versions 2 through 5. So they're using older versions of FICO. And always verify with your bank or lender. Sometimes some of them, very rarely, they're using Vantage credit scores, which are the newer score models. Some banks, some lenders are starting to use Vantage, but I'd say about 98%, maybe 99% of the banks and lenders that are out there are still using FICO, which has been around since like the 50s. So your mortgage company more than likely is using a FICO mortgage score version. And again, most lenders want to see about a 620, 640 to do a very good, I think it's basically a non-manual underwrite is what they call it. So it's kind of like a desktop approval. It's almost like an automatic approval using when you have a higher score, typically 620, 640 and above. Once you have the lower score, you're typically subject to a manual underwrite, which means you're going to probably have to have more financial documents, probably a higher down payment, probably have a higher interest rate. But, to be on the safe side, typically 620, 640 FICO mortgage scores will allow you to enter into an FHA type of mortgage. So with FHA loans, typically the interest rate is going to be a little bit higher compared to your conventional mortgage loan. And the truth, I guess, the true cost of an FHA loan, and one thing you also need to consider is that you're paying for private mortgage insurance, also known as PMI. And so when you kind of compare FHA loans to conventional mortgages, one of the main differentiators there is the private mortgage insurance. So with private mortgage insurance, typically that is where kind of like the government's guaranteeing the loan. And so in order for them to kind of guarantee the loan, they implement this private mortgage insurance. And in the case of a default, it kind of helps protect the loan. And so with private mortgage insurance, typically that can be anywhere between like 0.8% to maybe about 1.5% of the value of the loan rolled into the monthly payment. Depending on the type of loan, let's just say maybe like a $200,000 loan, that could be anywhere between like 50 maybe up to 100 bucks a month added to your monthly payment. And that's just for private mortgage insurance, and it's just for an event of a default, right? In the event that you don't pay the mortgage, there's basically private mortgage insurance to kind of protect the bank from any losses they may receive from that. So that's, basically added risk into the deal that you're paying for in your monthly payment. The bank rolls that onto you. And so that's typically the main differentiator there between an FHA loan and a conventional. So those are some things to consider, especially when it comes to your monthly payment. You kind of want to compare conventional and FHA. With FHA, you're going to have that private mortgage insurance. You may have a higher interest rate compared to your conventional financing, or if you have a higher score type of loan. And then, of course, the private mortgage insurance will be added into that. So those are some truth of the cost there. I'm sure there's other fees, maybe some origination fees, some closing costs that could be associated in there. But you definitely want to look at your private mortgage insurance quote and kind of verify what you are paying for as far as private mortgage insurance, and how that affects your monthly payment. Because for some people, what you pay every month to, for mortgage, taxes, insurance, all of that bundled in, you're trying to keep that cost down as low as possible when it really matters. So you're trying to save every dollar you possibly can when it comes to your monthly payment on your mortgage. So if you're looking for a much lower monthly payment, you may want to consider going conventional, which I'll talk about that here in a bit. So second point is the down payment assistance options, which are pretty popular, or at least it's kind of been like the rumor around the campfires, which is like, people have heard of it, these first-time home buyers. It used to be really big a couple years back where, it was marketed pretty heavily, maybe on TV, radio, what have you, get the $7,000 grant or $15,000 grant the government's giving out to help you buy houses. This was kind of really post 07, 08 after the mortgage meltdown, kind of like to kind of motivate the economy, to kind of push the real estate economy. The government stepped in and was offering a lot of grants, a lot of programs that are out there to kind of motivate people to go out and buy some houses, buy some real estate. And so the actual cost when it comes to down payment assistance programs, and the way that works is a lot of these are offered by the state, the local government. They're usually, whether it's the county or the state, is offering some type of grant, some type of offer to where they'll cover, your full down payment or close to your full down payment. So typically with an FHA, you're paying 3.5% down. That's pretty standard. But if you get approved for a grant or some kind of down payment assistance option, then they may cover, you basically would have to come to the table. They'll give you enough funds to cover 3 of the 3.5%. That would be the down payment, or 4% of the 3.5. I don't mean that in the form of like 3% of the 4%. That wouldn't make a lot of sense. But what I'm referring to is, like, let's say that the mortgage company is requiring 3.5% down. You get a grant that's going to cover 3% of the loan. Then you only need to come to the table with 0.5% for the down payment. So you instead of coming up to the table with maybe, let's just say $5,000 for a loan, maybe you come to the table and only need to bring like $500, right? So that's one option. Sometimes there's a program that will cover more than your down payment. They'll even put some money back into either, going towards closing or back in your pocket, maybe for some moving costs, things like that. And that's like the 4% grant. So while down payment assistance options, they help out on the front end, right? If you can come to the table with next to nothing down, and you kind of help with your upfront costs, that's definitely I'm a proponent of that. But where you want to focus on and where you want to pay close attention to is your interest rate. Typically, because of the grant, because of the program, the mortgage company has to deem the loan a little bit on the riskier end. So you may end up paying a 1/4 of a point or maybe about a point higher on the interest rate. So let's just say, as of today, let's just say hypothetically the mortgage interest rates right now are 4.5%. If you got a down payment assistance program attached to it, maybe instead of 4.5, you pay 4.75 or maybe 5% interest, right? So there's a difference there in the rate due to the fact that you're getting some outside assistance to help cover the down payment. And so where this could be be counterproductive is, again, if you're also focused on your monthly, keeping your monthly payment low, that interest rate is going to kind of factor into there. Of course, you can always refinance down the line, maybe 5 to 10 years down the road. You can look into refinancing that loan and get a lower rate, and maybe go from an FHA loan to a conventional. But that's just something to consider, is that you're going to pay, even though you're getting some help on the front end, you're going to probably pay for it in the back end in the form of your interest rate. So it's something to consider. I'm a proponent for down payment assistance if it's needed, especially for like single moms, people that are on fixed incomes, someone that just needs a little bit of help on getting into the down payment, or even single dads. And you can pay the bill, you can afford the monthly, but due to like your cost of living being on one income, it's just harder to get to a down payment scenario. Try to save up 3.5% down. It's harder because of all the other difficulties, and so to kind of help you get that going, to kind of get out of a renting situation and becoming owner and building equity, I'm a proponent of some help like that if need be. Where I'm not a proponent is if you got good income, you're making 70, 80 grand a year, even 60 to 70 grand a year, and you haven't done a budget in a while, and you're kind of spending money frivolously. Maybe look into creating a budget first. Let's say you're about 3 to 6 months out from wanting to buy a house, then you as opposed to just kind of relying on these programs and getting some down payment assistance help. Look into getting a budget going and try to save, between, 1,000, maybe, 1,500 a month if possible, and do that for 3 to 6 months. And, there you go. There magically appears your down payment for your house, and you don't have to do a program. You don't have to have a higher interest rate because of it. You're able to get in and get a much better type of loan, which then transitions me to conventional mortgages. So conventional mortgages, some truth behind that. A lot of people believe that with a conventional mortgage, you need to have perfect credit, like 700 plus scores, and you need to have 20% down. That's the only way to get a conventional mortgage. Some people believe that's the only way to get a mortgage in general. They don't even know about VA programs and FHA programs or these down payment assistance options. So many people believe that in order to get a mortgage, you need to have 20% down, period, plus A1 credit. Well, with conventional, there's some banks and lenders out there that will lend down to about a 660 FICO mortgage score. And the cool thing about conventional is that there's not any private mortgage insurance. So you get a lower payment, plus the interest rate typically is going to be lower on a conventional mortgage as opposed to FHA, because it's a better loan. And then two, also because theoretically your credit score should be higher when you're going conventional, because they have typically a higher score requirement. So theoretically your interest rate would also be lower. So no private mortgage insurance, lower interest rate, and 660 score requirement typically for most lenders. And you don't need to have 20% down. There's mortgage companies that do conventional loans between 3 and 5% down. Some require 10, but I'm starting to see a lot more lenders only require 5% down. So, that as opposed to having to wait to 20% down to get a conventional mortgage or a mortgage in general, there are some options around conventional financing. The only challenge is you need to have a higher score requirement, and then you need to have a little bit more down payment. There are some lenders that can bring in a down payment assistance program to a conventional mortgage. It's extremely rare, but it's definitely possible. So you just want to focus on your score, getting your credit score up as high as you possibly can, and saving some money. Now, as it relates to your credit score, if you are in the process of becoming a homeowner and you want your credit report looked at for free, my team is more than happy to schedule a complimentary credit report evaluation. Maybe you're in the process of becoming a homeowner in about 3 to 6 months. You're looking to save some money, but your credit is not the strongest, and you need to work on your credit a little bit. Well, here at the Credit Agents, my company here, we'd be more than happy to take a closer look at your credit report, go over with you thoroughly, set up a good game plan. Even if you don't hire us to do all the legwork for you, that's totally fine. At least you get some clarity. You'll understand, what you can do on your end to begin raising your score. Kind of hear from my team of experts. We don't charge you for the information, the consultation. That's completely free. Of course, you want to hire us, then they'll go over, some options on our fees in terms of, what it would cost to have us do all the legwork for you. But at the very least, get some clarity, kind of get some ideas of where you're at credit-wise, what you can do to start raising your score, so you're best prepared and ready before you apply for a mortgage loan. So firsthand you have the highest score possible, which could give you the best mortgage possible, which could give you the best interest rate possible. Because keep in mind, you're financing this thing for 15, 20, maybe 30 years. Most people do 30-year fixed mortgages. So, half a percentage or even a quarter percentage on the interest rate over 15, 30 years makes a big difference. It can amount to quite a bit of money. So you really want to get your credit, perfect as can be before you apply for a mortgage loan so you get the best deal possible. So click on the link below if you want to schedule. I'll put it in the description. So if you want to schedule a complimentary credit review, my team would be more than happy to do that. Again, I'm Joe Chavarria. Thank you so much for tuning in here. I'll see you on the next one.